Okay, recording this video Friday 2nd of November 2012, and we've had some important moves in the forex markets over the last week that I want to talk about, but I want to talk about them in terms of the context how to protect your wealth from currency depreciation. This video is going to be a little bit of a refresh of a video I did a year ago with some additional information, plus there's going to be a second part to this video I'll put out in a couple of days' time, so look out for that. So let's talk about wealth protection. I always think there are three levels of wealth protection, things that are happening to you that seemingly on the face of it you kind of can't control. So the first one of those is protecting your wealth from theft, confiscation and changes to the law. Good example of this is some of the hedge funds that invested in Russia over the last 10 years or so. Businesses kind of doing well, funds are flowing in, they're being invested and so on, then all of a sudden state officials kind of come in and sequester the assets and says, no, that doesn't belong to you anymore, it belongs to me, on your way. And bit of an extreme example of changes in the law and kind of assets being confiscated, but the point is you need to have your savings and investments in places where you are confident in the rule of law, kind of the property laws and so on. And when people talk about kind of there being extreme uncertainty in the financial markets right now, I agree with that, but I don't see it necessarily in the volatility of the prices. I see it in terms of the uncertainty in what's going to happen in terms of the changes to the rules and the laws. So that's an important kind of consideration when you're protecting your wealth. Make sure that you're in jurisdictions and countries invested and saved, places where you have confidence in what's going to happen in the future, and be very aware of potential changes in those laws and things being taken away from you out of your control. Second level of wealth protection is protecting yourself from high taxes and high fees. Now, in today's world, there's no such thing as kind of no taxes. It's just a question of degree. There's taxes kind of everywhere from low to high. And so being invested and saved in places that have reasonable tax rates or low tax rates, and certainly being in account structures that have low fees and not high fees. So again, things that you need to do in order to actively manage your wealth so that you maintain it from being highly taxed or taken away with high fees. The third level, and really the subject of this video, is to do with what I call passive currency devaluation. So having your assets and your savings in a currency that is gradually over time being devalued. And so although your assets and your savings might be going up in nominal values, in real terms, what you can actually do with that money is being kind of whittled away kind of year after year because your currency is going down in value. You need to protect yourself in terms of those three levels of wealth protection. Then after that, once you've got those things right, then you can start thinking about active investment decisions for capital appreciation. So if you've not got those three things right in terms of protecting your wealth in the first place, you're kind of swimming against the tide. Whatever decisions you make in terms of active investments, they're just going to be swimming against this tide of your money being either confiscated, overly taxed, taken away with fees, or in a currency that is kind of depreciating over time. So let's talk about this third one, currency kind of devaluation. I'll just bring up a chart of the Aussie dollar and let's talk about a real example in my actual experience. So back in 92, this is a chart of the Aussie dollar versus the US dollar. Back in 92 I moved to Australia. Company I was working with, I was based in California, decided to open an office in Melbourne, Australia, and they said, would you come down there and help start the office? I said, love to. There's lots of surf, as everybody knows, in Australia, so kind of count me in. Brought down for an interview at the end of 91, and I negotiated my salary package based on what the exchange rate was at that time. I was pretty naive, I suppose, at the time. Just went into the HR department. They said, well, the current FX rate is this versus the US dollar, therefore this is what your local salary will be in Aussie dollars. I happened to be working on a long-term project in Korea at the time and didn't end up kind of coming to Australia and actually settling for another 9 months. When I eventually arrived on the ground, this is what the currency had done in the meantime. So I negotiated my salary based on about 77, 78 to the US dollar. And then when I arrived and was trying to negotiate rents and figure out how much the money was worth, and I converted it back into US dollar, I was horrified to find out that in real terms, my salary had just decreased by 10% over that time. At the time, Australia was going through quite a nasty recession, 92, 93, we had a little bit of a mini kind of property collapse and a mini recession kind of going on there. We did eventually bounce from that, and the Aussie dollar, did strengthen in the months to come. But that actual kind of salary negotiation and my naivety about foreign exchange rates meant that, without even doing anything, I just negotiated effectively a 10% plus decrease in my salary by not being aware of what was going on in the currency. Let's talk about how you should be tracking what's happening in the currency markets and making decisions appropriately. So let's talk about, first of all, the long-term Forex trends. The first thing is Forex can be quite confusing. There are literally dozens and dozens of different Forex pairs that you can look at, but I always think they break down into two camps. It's basically the US dollar versus the rest, whether you're looking at the euro, pound sterling, the Aussie dollar, the loonie, the Canadian dollar, and so on. So let me just bring up a chart of those currencies over the long term. This is going back to 2000 with an index chart of all of the major currencies versus the US dollar. So we've got here in white, we've got the Swiss franc. In green, we've got the Aussie dollar. In purple, we have the Canadian loonie. In yellow, we have the Japanese yen. In blue, we have the euro. And then in red here, we have the British pound. And lastly, down here in bold cyan line, we've got the US dollar index. So the US dollar index is based on a basket of these currencies. The primary, the most important one is actually the euro of those basket of currencies. So you can see a couple of things on this chart. First of all, there's two currencies that kind of stand out as kind of not really kind of playing along. The first one is the British pound. The British pound seemingly kind of moved with these other currencies over this last 7-8 year period, and then basically went back to parity. Back to kind of the index line at 1. I always think of the British pound as being so similar to the US dollar. Yes, there are kind of fluctuations from time to time between the US dollar and the British pound, but in the long term they're kind of quite similar, and so I kind of don't think that as being a high volatility index and not necessarily the one that you should be looking at. The second one that kind of stands out a little bit is the Japanese yen. So the Japanese yen here, during some periods it's a currency that looks like the US dollar because it's one of the kind of major currencies involved in the carry trade. At other times it looks more like kind of the risk-on charts, the euros and the higher beta type currencies. So the Japanese yen is kind of a little bit of a standout, and I don't necessarily understand how it works. So I kind of think of those two kind of falling outside of these groups. But excluding those two, you've got some really tight ranges when you look at everything else. You can see they're moving within a fairly tight band with kind of moving higher versus the US dollar and then kind of coming down here. And we've had various kind of periods where the US dollar versus these other currencies have moved in distinct trends. The first one kind of leading up to 2002, and this is the bull market in the US equities market leading into the tech wreck and so on. We had extremely strong trend in the US dollar and weak in everything else, and that's because basically we had a huge amount of money flowing into the US investment opportunities. Then in 2000 we had the tech wreck up until 2008, and at this point here, really this was after 9/11, we had the intervention of the Fed, and we had the Fed kind of printing money and actively becoming very active in terms of devaluing the US currency. And you can see dollar index kind of sank down quite dramatically here, and all of the other currencies started to move ahead really strongly. Then we had global financial crisis 2008, and we get a blip here for about a year. Huge uncertainty in the markets, huge downward volatility in the markets, and everybody flows into safer assets, which at that time happened to be US dollar, US bonds, and repatriation of funds from carry trades into the US dollar and into the yen as well. And then from 2009 to kind of mid 2011, we've got the US dollar continuing to kind of sink, not to lower lows, but doing worse, and some of the other currencies doing considerably better. For example, the Swiss franc went on an absolute tear. And then since about mid 2011, we've had a little bit of strength in the US dollar, and some of these other currencies have started to come off. So we've got kind of big, broad trends, and this is what we're trying to capture by working with the currency and getting away, protecting your wealth from passive currency devaluation. You don't want to be invested in have all your assets in US dollars if the US dollar on an index basis is going from 1.2 to 0.75 down here from 2002 to 2009. this kind of period you want to be out of the US dollar and you want to be invested in higher beta currencies. So Euro Classic over this time period in blue you can see here appreciating really strongly. Then when the financial crisis hits, yep, you want to move your assets back into US dollars, then out of US dollars during this period and into US dollars during this period here. So that's broadly the way the forex markets kind of look. So although there are dozens and dozens of different forex pairs, they break down into two camps, these kind of risk on or the high beta type currencies versus the US dollar index. And that's the way you should be doing your analysis, looking at all of these in kind of as a basket versus the US dollar. The second point to note is that tracking forex trends, you're looking for breakouts into trends on long-term charts. And for these, the most logical thing to do is use the better indicators on some of those charts. So let's look at those and what's happening today, because over the last week we've had some important moves in the dollar index. So here we go, this dollar index daily chart here, and you can see we've got the better indicators on here. This is the futures market of the dollar index from the CME that gives us volume data. The cash index will not give you volume data for each of these forex pairs, and so that's what we're using. We're using the CME data of the futures contract for dollar index, euro, Aussie dollar, and so on, kind of going forward in these charts. So you can see over the last month or so we've had a huge sell-off in dollar index that ended up with exhaustion selling, and all these blue professional bars kind of come in down here at the lows, 78, 78.5. We get a little bit of a bounce into pullback to end of trend. This is a dirty end of trend. There's no end kind of signaled text coming on the chart because the pullback level was violated, but that's what I call a dirty end of trend. And at the same time here we have a bullish divergence pattern and a flush signal, flushing out the sellers at that point at this kind of 79 level. And then from there we've had a little bit of a strong rally, come into a resistance level on this daily chart, and in the last couple of days what we've done, we've marked that resistance level, we came back down, and now we're having another go. Now if we break through this resistance level and keep going, this will be a breakout into a trend on the daily chart, which could be quite significant. When we start going up the time frames, so the next chart up would be the weekly chart here, you can see during the last couple of months we've put in a cyclical low in terms of the weekly chart, and we kind of got that strength behind us on the next time frame up, supporting a rally in the dollar index. And then when we go to the monthly chart, we can see over the last couple of years where we had the sell-off in the dollar index in kind of mid-2011, we had all these exhaustion selling signals down here. We had some cyclical support on the monthly chart coming at 75, and then the activity over the last couple of months is we've got a couple of amateur down bars. So the selling that we've had over the last couple of months has been driven by the amateurs, kind of low average trade size, and we're bouncing from there. That is like a little bit of a classic test. We've had the professionals acquiring at these lows, the amateurs kind of getting wrong-footed here. It's testing the strength of the market, and we're starting to rally from there. So a breakout on the daily chart here in on the dollar index would mean strength in the dollar index. And I know everybody's, there's a lot of talk in the general media about, fiscal cliff, what if the US dollar and the US bonds are downgraded, we're going to have a collapse in the US dollar and so on. Just look at the charts. The charts will tell you what's actually kind of going on, and what I'm suggesting here that we have potential for a strong breakout in the US dollar, and this could be accompanied with significant weakness in the equities market, and we've also got strength in the US bonds. So first chart to look at is the dollar index. Second chart to look at is the biggest kind of component of the dollar index is the euro. So let's look at the euro, and we all know about the troubles that we're having in Europe. Absolutely, appalling in terms of the social cost in Europe and all of the disruption that we're having kind of down here. Greece, been happening over the last 3 years. Spain has really exploded in the last year. Italy is starting to kind of tick over, and we've got kind of all kinds of problems happening in France as well at the moment. Now, daily chart of the euro, yes, we bottomed out at the beginning, mid this year at 120 kind of level down here, psychologically very important, and then at 124 we break into this uptrend here above resistance on this daily chart. Come into a nice little uptrend, we peak about 132 versus the US dollar. Blue professional bars kind of coming in here. We've come back and made pullback to end of trend. We briefly overshot the end of trend level here, and we've come back down. But we've now got a daily support level coming on the daily euro chart, and we're breaking below that, potentially breaking support into a downtrend on the daily chart. We've had our tests kind of at this point here with bearish divergence kind of come in, and the last few days here at the beginning of this week, you can see amateur up bar. At the beginning of the week, kind of amateurs kind of trying to buy the market, buy any weakness that we had here. They're getting wrong-footed, and a break below support here on the daily chart, potentially into a downtrend on the daily chart. Go up a time frame onto the weekly chart. You can see, yes, down at the 120, kind of mid this year, we had exhaustion, selling, end of trend, bullish divergence, and we rallied from there. But on the weekly chart, you can see we've just had one cyclical resistance line plot, so that's showing a resistance line on the weekly chart. The move into these highs was also driven by the amateurs here at this last kind of point here. That's an amateur kind of average, low average trade size coming into that 132 level there and starting to come back down. And then looking at the monthly chart here, we've also on the monthly chart over the last couple of months kind of weak amateur up bar into that kind of turning point. So we've seen some weakness in the euro chart. The other chart I like looking at is the Aussie dollar, because partly I'm based there part of the year, but also it's one of the high beta, high kind of risk on charts of all the currency pairs in the world. Tends to move quite closely with the Canadian dollar, the loonie. But the Aussie dollar will be kind of one of the strongest of the risk-on charts when the risk-on markets are advancing. So let's just look at what's been happening of the Aussie dollar over the last few months. So topped out in August at about 105. We had exhaustion buying and bearish divergence come in here, and a blue professional bar and some Rambo patterns. So amateurs, potential reversal of an amateur breakout, that's what a Rambo pattern is, showing kind of weakness at these highs. When that happens with exhaustion buying, that's an unstable pattern. We kind of sell off into 101, kind of down here. The professionals come back in, and the market kind of retests those highs, but then comes back again into 101. We look like we've come back up to a resistance level there. We've been playing around this resistance level for a couple of days, kind of breaking above it, maybe breaking below it. We've got amateur activity here, and you can see less and less buying going on. We've got bearish divergence signals on better momentum at this 103 type level. In terms of the Aussie dollar, the critical level versus the US dollar is parity at 1 versus the US dollar. So any move back down to 1 and through 1 into a downtrend would be very bearish for the Aussie dollar here. Weekly chart of the Aussie dollar, you can see again we've been playing around this resistance level up here on the weekly charts for several weeks. Can't get through this 105 level. It's been a Rambo pattern, the last push up to it. We've come back up to it. Very weak buying at the moment, potentially rolling over on the weekly chart. And if we go to the monthly chart again, you can see all this activity over the last year and a half. We maxed out with exhaustion buying. We came up to kind of almost 110. We've been testing around this levels, and we just can't get through for the time being. So third chart to look at is the Aussie dollar in terms of being a high beta chart. You look at the dollar index, the euro as being the largest component of the dollar index, and then the Aussie dollar. It's quite a big component of the dollar index, but it's important because it's a high beta chart, and so it'll show kind of the risk on activity. It'll tend to move more than the euro in both directions. So there we go. Look for breakouts into trends on the long-term charts. Third thing to look at is gold and silver. Gold and silver are important because they're anti-dollar. So when the US dollar goes down in value, gold goes up in value. Case in point, from 2001, 2002 to 2008 or 9, we had a huge advance in the price of gold. Gold had bottomed about 450 or something like that. 2000, we had a huge advance in gold up to almost 2000 last year, and a lot of that was being driven by money printing, currency printing, effectively QE. Happening by the Fed over those years, and so gold is reflective. Gold goes up in value when the US dollar goes down in value. So you can look at the gold and silver charts as well to understand the strength or weakness in the US dollar. So let's go to the gold chart again, looking at the better indicators on a daily chart. And this is gold on a daily chart. You can see over the last couple of months had a huge advance, blow-off activity with exhaustion buying. Blue professional bars at the highs, bearish divergence kind of come in. We go to make a pullback level in an uptrend, and we don't make pullback to end of trend. This market's so weak it just falls through the pullback level, bang. We come back up to test that pullback level. Support becomes resistance at that point. We kind of kiss away from that level and we're back down at 1700. 1700's very important level. 1800's been important. 19 on the way up. So all the hundreds are important in terms of psychological levels for gold. So if we fall through gold, a decline in the gold market will show that there is strength in the US dollar market. Again, going to the weekly chart here. And this is what we've had over the last year. So we had this maxing out at over 1900 in the gold price. We had exhaustion buying, blue professional bars at the highs here. We kind of came down and make a low, pull back to end of trend, and we bounced off that level here at just under 1600 with the Rambo pattern. Bounced into this high at 1800, and we've been traveling in this wide range ever since. Well, the last time we've come into this on the weekly chart, we've come into resistance. We moved away from that resistance line, so we're traveling resistance to support. And then on the monthly chart, you can see that was the explosion in the gold price. Exhaustion buying, bearish divergence at the top. This last move been kind of an amateur up bar, kind of into those 1800s. Been a lot of kind of all the gold bulls kind of been talking up the gold market, saying, you know, never a better price to kind of get in because we're going to, you know, 5,000, 7,000, 8,000, whatever, you know, at this point. And in fact, when you look at the chart will tell you what's happening. We've broken into a downtrend on the daily chart. We kissed support becomes resistance. We're kind of rolling over, and this is looking very weak. So we're not being caught on the way down. No blue professional bars kind of come in to acquire this yet at the lows. Similarly, silver tends to be, again, a high beta version of the gold chart. Sometimes in the last couple of years it's kind of moved out of sync with the gold market, but eventually it did kind of catch up. So on the daily chart, it's very similar to gold. We've had exhaustion buying, all these blue professional up bars, professionals taking profits, bearish divergence after our exhaustion pattern. We kind of fall off. Same thing, we fell through the pullback support level. We've come back up, kiss and test it. So support becomes resistance. We roll away from there into a continuation of the downtrend. On the weekly chart, same pattern as gold. We had this extreme, you know, exhaustion buying up at $50. We had all these blue professional bars, exhaustion buying, bang, the market came back up to test with another pullback to end of trend sequence here, and we've been in a downtrend ever since. There's the Rambo pattern, similar to where gold kind of bounced off the Rambo pattern. Blue professional bars, the professionals again at, you know, almost $40. We're taking profits here. We come back in. We come back to test at 35. Blue professional bars again at cyclical resistance, a flush pattern of flushing out the last of those buyers, and we're now in a downtrend on the weekly chart. And if we go to the monthly chart, exhaustion buying, that was the peak at $50. We've been bouncing off this pullback level, so at some point we'll kind of make that end of trend on this monthly chart, and kind of that trend move will be over. So gold and silver, important markets to look at because they're anti the US dollar. So whatever the trend is in the gold and silver markets, you kind of reverse that for what the trend ought to be in the US dollar market. So silver and gold going down, therefore showing that there'll be strength in the US dollar market. So that's the second kind of suggestion for you. Look at breakouts into trend on the long-term charts. Follow gold and silver, and then the final point is look for the commitment of traders numbers on those charts, and look for divergence patterns to show what's happening there. So let me just show you a couple of commitment of traders charts. The first one is the dollar index chart, and you can look at these in terms of weekly and monthly charts. Remember, commitment of traders numbers just comes out once a week. It's kind of, the data is delayed. We get it on a Friday, kind of late in a Friday from, I think it's the Tuesday data, so it is delayed, and it's only once a week. Dollar index, you can see down here at this kind of 77 level, we had all these bullish divergence signals here. Now I take the commitment of traders numbers and I flip them upside down, and I use the same algorithm from Better Momentum to determine the divergence patterns here. So at this point here, we're coming into 77s, we've got all these bullish divergence signals, and the market starts to strengthen. Last signal on the weekly chart was a bearish divergence, and we did have a fall off in the US dollar here. But if you go onto the monthly chart, you can see the same things. There's those bullish divergence signals. The last signals that we've had in terms of divergence on commitment of traders have been bullish, supporting the dollar index at that point. Although we've been kind of flipped upside down in terms of what the commitment of traders have been doing over the last several months, this could easily just turn around. That was quite shallow in terms of what the commitment of traders were doing, so they could reverse their positions quite easily to support a rally in the dollar index. And then the other one to look at is, for example, the euro. So you can look at gold and silver in terms of commitment of traders and so on, but just showing you the euro chart as well. So this is the weekly chart on euro, and we've been in a downtrend on the euro market. We had the last signal we had was a bearish divergence signal here in the euro. We've fallen off from that 145 level, kind of mid 2011, into a strong downtrend, and the professional activity is all kind of supporting that move into a downtrend. And if we look at it on a monthly chart as well, again 2011 we had these extreme kind of levels here with bearish divergence on the commitment of traders supporting a downtrend in the euro market there. So there we go. 3 charts to look at in terms of figuring out what the long-term trend in the forex markets are. Look out for breakouts into trends starting on the daily time frames and kind of moving into the weekly charts. Follow gold and silver because they're kind of anti-correlated with US dollar. And then look for the commitment of traders and look for divergence patterns on the commitment of traders numbers in order to kind of support your analysis. And what you need to do is kind of use a combination of those to figure whether you should be in or out of the US dollar, and if you're going to be out of the US dollar, which currency pair are you going to be in? What's the strongest currency pair at that time to get into? So there we go. I'm going to do a second video over the next couple of days just talking about that currency overlay and how you can actually implement that in your long-term investing and trading strategy. So I hope you found that video helpful.